So when a partnership is faced with, at the end of a 5-year period, of having to put a new loan on with a higher rate, it's sort of a forced sale. And in most cases, the debt really drives the life cycle of the ownership of the asset. When it's due, got to sell it.
Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Hey folks, welcome back to the show. Today's guest, David Vandenburg, is in the value-add multifamily space, partnerships with family offices, institutions, and real estate funds. David, welcome to the show.
Thanks for having me. Glad to be here.
Great to have you on here, David. We were talking before hopping on here about really all that's entailed in the strategic relationships that you have with these family offices, institutions. But before we hop into that, I do want to ask you about your background. How did you get into real estate?
Uh, it's kind of interesting. My father had been in the business since he started as a broker in the late 70s and then became a principal in the early 80s. I believe the first transaction they principal was in 1983. And I attended college at SMU in Dallas and graduated with a bachelor's degree in business with majors in finance and real estate. And prior to going to college, I had summer jobs that I worked on apartment complexes. I had been around the business, for a long time before I got serious about it and was studying real estate and finance. And then when I finished, I moved up to Chicago and just dove into it immediately. Um, in doing, really on the deal side and working on acquisitions, uh, really right from the get-go. And
I want to ask you
hard.
specifically about if I was to meet you, you're at SMU. Uh, Were you thinking at that point in time you wanted to get into commercial? Were you thinking at that point in time maybe you were going to go and be a real estate agent and then broker? Did you have an idea where you wanted to be at when you were leaving SMU?
No, I mean, I really didn't. It was, I had completed my studies and I was really interested in just getting out in the world and beginning to work. Um, I had the opportunity to join my father and his side of the business up in Chicago. And I spent some time up here, but I had never lived in the city other than I'd spent a summer um, in the city before I graduated working with him. So still getting my feet wet in the business. And I found it to be, fairly exciting.
Yeah.
I knew it could be rewarding, financially rewarding. Um, and I like the pace of it, fast paced. Um, you were able to sort of make your own path. Uh, Even the days, each day could be completely different from one to the other. It was not mundane and redundant. Uh,
Uh-huh. Uh-huh.
and I was always learning new stuff. And really, a lot of the things that I had learned in school at that time, uh, almost ironically, things when I was a senior, we were studying securitizations, which was something that was really new to the real estate business at that time. And when I finished and came up to Chicago and started working with my father and the others that were in the office, um, we were part of one of the first multi-borrower, um, multi-asset, non-cross collateralized uh, securitization pools that were
Hmm.
assembled, sold to the market. And that was on behalf of DLJ, Donaldson, Lufkin, Jenrette, that was one of the pioneers in the space. They later that business later sort of merged with Credit Suisse versus Boston, but that was the first of a number of transactions that we did with them. Eventually, we sponsored our own bond offering where we had it was secured with I think it was 19 or 21 properties that we with um, a couple different pension funds that were administered by an advisor. Their real estate portfolio was administered by an advisor at Philadelphia. We um, got into partnership with.
Now,
And
were these publicly available? Did the people have to go through their financial advisor for access to them?
so that pool of that securitization pool, there were several different tranches. That it was divided up into one of those tranches, depending on where it is in the priority of payment for the capital stack, and earn different rates of return. It depending on whether it was sold at a premium or a discount. The face amount of the note. So the talk about interest rates. The interest rate on that single asset borrow pool that we sponsored ourselves,
Yeah.
uh, that had a coupon rate of 9.23% and a 25-year amortization schedule. So a debt constant that well over like 10.5%.
Hmm.
And we had like 21 properties that not only supported that debt structure, those debt payments, but it returned like 12, 13% to the equity, uh, while that debt piece, that securitization um, financing was in place.
I
That was
want
a
to
real
pivot. I want to pivot a bit here, David.
sure.
Ask you about those early days. Um, when I hear your story, and we're talking now about complex ways that deals are being structured, right? So you're talking about tranches and pools of money, and then also uh, there's so much that goes into this. The acquisition side, when you're looking for the deals, there's so many people that are on our podcast who um, are sourcing deals, whether from single family all the way up to flex use commercial.
Sure.
Was your experience in those early days at all on the acquisition side?
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
Almost 100%. That was really where my almost all my focus was. So um, we were very active in Texas. I grew up there. I went to school there. Most of our properties that we acquired um, have been in Texas. I think we, at one point, well, I don't say at one point, over our history, we've owned more than 75 properties in the state, probably represents maybe 20,000 units, maybe 15,000 units, in all the major cities, a lot of the secondary and tertiary cities. So I was learning, yeah, the business from the ground up, but really, I'd had some of that experience previously with some summer jobs, and um, whether it was leasing apartments, I'd done some maintenance work, and then as I got into the acquisition business, I'd had my education in finance and in real estate that really enabled me to understand how uh, how to finance the property, how to underwrite, the numbers, and so I learned really just by getting by being in it. I wasn't really taught as much as I, I learned on the go. So I was immediately in the acquisitions business, and that has really been my strong suit, and where I have most of my attention over the years has been on the acquisition side. I
When we
always said that.
when we're talking
Go
about
ahead.
Texas acquisitions, you mentioned 70 plus properties, thousands and thousands of doors. Was this all commercial residential? Was it multiple asset classes?
No, it was all apartments, all larger apartment properties. Generally, our focus was always to try to. They were almost always properties that were at least 100 units, and really trying to focus on properties that were between 200 units and, let's say, 400 units. But we had a handful of properties that were over 800 units. Each of the properties were had over 800 units. Um, there were a few properties that we had, some that we bought in portfolios that were over 100 units, but not over 150 units, 120 units. Um, I don't know that we had, I think, maybe two properties that were smaller than 100 units. We had one in Atlanta, I think was 85 units, and another one in Orlando that was maybe 90 units. But most of those properties were sort of really good deals that were too good to pass up, but we had existing property in the marketplace that gave some synergies to operations and uh, helped make sense of spending time to do the acquisition. We generally like looking at working larger deals for a myriad of reasons.
Was there any point in time where you were looking at other asset classes? I've spoken with people who are in the space, and I've heard a mix of things, but I find it interesting that you zoned in on commercial residential, those apartment complexes. Right now,
Sure.
people are talking about flex use commercial, self storage, retail. Uh, was there something specific that uh, drew you heavily towards the commercial residential side?
So, sort of twofold. We had some experience, more so, um, before I was with the company. Before I was actually, working with the company, we owned some office buildings, and some shopping centers. Um, the key, or the attractiveness of the multifamily space, was that housing is something that you that everyone needs. You don't
Needs.
necessarily need a retail center or an office building, and those have only become more exacerbated over time. As we know
Yeah.
today, really two of the softer sectors in the business because of online shopping and Amazon and work from home, in particular, right? But people still need places to live, and we still have a real serious shortage of housing, both rental
Absolutely.
uh, and single family housing, whether that's rental or owned. But um, it was always the fact that there's a need for it. People are always going to need a place to live, And then there were attractive financing programs for multifamily, where the financing that you could obtain for retail and office wasn't as attractive. The rates weren't as attractive. The ability to get as much financing as you could was more problematic with retail and office. So uh, w- we were never really in the industrial space. We did manage um, a couple million square feet of industrial space. Most of that in Texas, in just a couple markets. It wasn't as intensive as the apartment business is really one of the
Yeah.
more intensive on the management side. Um, so we felt like there were some things that we could really add to uh, the management side and our business that would give investors and partners additional comfort and additional reasons to invest with us, because there were things that we were doing that maybe other organizations necessarily weren't doing in
I'm curious,
terms of
wh- when
process.
folks are coming to you today. I have had investors on this show who will tell me I'll look at deals anywhere in the country, even the world, and then I'll have investors uh, who will tell me the exact opposite, right? Unless I have experience there, unless I have a strategic relationship there, I'm not looking at these deals. You have had long history in Texas. You're in Chicago. I heard that you did a deal in Atlanta. What has been your approach when folks are bringing you deals in maybe markets that you have not done deals with previously or not have such an extensive track record there?
Sure. So we were pretty fortunate. We were pretty uh we were in a lot of markets. I think we owned and operated in over 40 different markets. I mentioned we were all over the state of Texas. We were in several cities, markets in the southeast. We were in most of the markets, the larger markets in Florida. We're in Atlanta. We've owned and operated in Birmingham, Jackson, Mississippi. Um, Several markets in Louisiana, Little Rock, Oklahoma, St. Louis, Kansas City. I think we had 15 properties in Kansas City, Chicago, Ohio. That was Columbus,
Yeah, all over.
Michigan, Kalamazoo, Michigan, Madison, Wisconsin, um, in New Mexico, in Albuquerque, New Mexico. We were in partnership with the Hunt companies, and we redeveloped the housing on Kirtland Air Force Base. Both Hunt developed new housing, and we renovated the existing housing, the existing base housing. Um, Been in Colorado, Denver. We had a couple properties. We did a condominium conversion in Littleton, Colorado, with a large developer here that we've known for a long time in Chicago called Golub. Um, so we converted a newer built garden style apartment community. It was like, I think it was 317 units that we converted to condos and sold.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency, it's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
Uh, we were in the DC Metro in Maryland, in Southern Virginia, in Newport News. Um, so we've been in a lot of different markets. I would say what you learn sometimes is what you don't want to do again, right? Whether they're mistakes or they're properties that didn't do as well for different reasons, and a lot of times you're able to overlay that or use that experience and correlate it with other markets where there are opportunities or that you want to, you don't want to venture into for different reasons. Um, Today it's a little different because there's different things that have been going on politically at the local level that have made it more challenging for apartment operators. Texas is real um, landlord friendly market.
Yep.
The eviction process is easier. It's more challenging in Chicago on the eviction process, but um, the market itself, uh, for being a really big urban city, the amount of rent that's required that goes towards rent is one of the lower uh, ratios in terms of rent payments to the take home pay as compared to some of its comparable markets like New York and Washington D.C., Boston, San Francisco, where that percentage of your rent of your income, that percentage of your income that goes to rent is significantly higher. So I guess my point is that while there's the eviction process is more difficult in Chicago, you're not faced with having to evict people nearly as often as you are in some of the other markets.
I
So,
do I do want to ask
go
you
ahead.
about on the acquisition side, pivoting to back to that. I'm sure there's many different strategies over the years which you've looked at and used on so many different properties, but do you generally look for distress or the whether that's financial from the seller or whether that's management or high vacancy rate, mismanagement, something along those lines? Or is that
Sure.
something once you identify distress that you then avoid the deal because it's now going to be less turnkey?
Yeah, so it has changed over time. And in the 90s, for example, there wasn't nearly as much new construction. There was very little construction because of what had happened through the late 80s and the RTC days. When I first joined the business, we were bidding on portfolios of properties that were owned and being auctioned or sold by the RTC. That went on for 2 or 3 years. And those were deals where uh, individuals and companies made huge amounts of money because properties were being sold at huge discounts to replacement cost. And in a lot of cases, they were really in the properties were in good shape, and the operating fundamentals were really pretty good. Um, as you got into the latter part of the 90s, construction started to happen again, but there was a need for better housing, but there wasn't a lot of newer housing. So we were renovating housing. We were doing a lot of renovation of older properties, not necessarily 30-year-old properties. Some of them were 10 years old, some of them were
Yeah.
20 years old. And you could do renovations and have newer, style kitchens and a lot of times it was fixing deferred maintenance and things like that. But all of it led to higher income, higher occupancies, better tenants. And so that was a way to value engineer, properties at the property level. And sometimes there was distress at the ownership level. Um, and sometimes there was distress at the property level. One of the first properties that we bought in Kansas City was a property we bought from Prudential. We paid $6,000 a unit for a 455 unit property that we then spent about $27,000 a unit in the property to renovate it. And it wasn't just renovation like doing interior work. We really did a lot of work to the exterior of the property. We pitched the roofs; they were flat. We ran the utility lines for the AC units, put those on the ground instead of on the roofs, and um, new windows, things like that. And cost for materials were was much more affordable than it is now. So it's hard to translate what 6,000 or 27,000 dollars a unit would be today. But we did substantial work there, and those properties, that was almost like a ground development, from the ground up sort of project. Um, as you got into the 2000s, there was more construction happening, and so what we found ourselves doing was trying to buy better properties at good discounts to replacement costs that were in good locations, that were not necessarily brand new, but were really nice properties in good shape. And then we could do things to them either initially if we felt that there was upside that could be attained um, from doing some renovations, or we might do it 2 or 3 years into the ownership of the asset, where we felt that the market was poised for some renovation, and it would be accepted, and new tenants would pay the upcharge. Um, and then what we've been doing the last, really, since the pandemic, and I'll say right around March and April of 22, when there was a seismic shift in financing rates, really led by the bond market, um, and bond yields really increasing substantially suddenly. And that was really as a result of the money that was being spent and what had happened with inflation. It was late to respond, but when it did, it was pretty substantial. I mean, it bankrupted a lot of
Yeah.
different groups, and it's been tough for those for if I can, like, put it this way, of all the deals that we have reviewed, toured, analyzed, bid, put offers out on the past 3 years, maybe 5% of those properties, and these are all basically A properties that have been constructed in the last 10 years or newer. Almost all of those partnerships or those properties are underwater.
Mm.
There's very few, unless the owners acquired the properties prior to 2017 or 18. Most of those partnerships, there's stress at the partnership level. The properties are in good shape, but the partnerships are underwater. Yeah, most of the equity, a good, substantial portion of the equity has been lost. Um, Sometimes you're at or near what the debt balance is. So there's a lot of stress on the partnership level, but the properties, most of the markets are really operating pretty well, other than the markets that have received too much construction. The last 3 years, we've had the most construction in the apartment business in the history of it. It's been a little over 500,000 units delivered each this year, last year, and the year before. So it's softened up some of the markets. The markets that have really, justifiably received a lot of that construction, because that's where most of the job growth has been, and population growth in Texas and Florida in particular, but Nashville, the Carolinas, Atlanta,
Now, when there is stress at the
Phoenix.
partnership level, like you talked about, how are people able to identify that? I mean, it's mainly partners reaching out to buyers, I would imagine, because if the property itself is in good condition, it may be hard to ascertain that the partnership itself isn't doing well.
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
Yeah, most of it is really driven by the debt market. So most of these partnerships placed debt that had a 5-year term on the loan. And so properties that were bought in 2018 or 19, they came on the market in 2023, 2024 when their financing was coming due, and they either had to refinance the property, and in most cases with the bond rates having risen and spreads in many cases having widened, that the financing that they could obtain to refinance the existing financing that they have um, didn't make any sense. They were going to have to come out of pocket to put additional equity in order to put new financing on, because the new financing, the property operations and income would only support financing that was basically below the financing that they currently had on the property, the existing financing. So when a partnership is faced with, at the end of a 5-year period, of having to put a new loan on with a higher rate and having to come out of pocket and to pay off the old loan, 4 or 5, maybe 10, $15 million, depending on how big the property is and how badly it's underwriting under today's debt standards, that they're sort of forced to sell. And in those cases, they're selling the property, and most of their equity is gone. And the only other choice that they have, the only other option, is to put less attractive financing on it and then come out of pocket with their partners to fund the difference between the existing financing they're paying off and the new financing they're putting on. So it's sort of a forced sale. And in
Mm.
most cases, the debt really drives the life cycle of the ownership of the asset.
I want to ask
When
you
it's
one
due,
one
you got to
more
sell
question
it.
about that. When we're
Sure.
talking about the apartment complexes, new construction, these people will have syndications, funds, investors, people pooling money together. Will In a situation like this, when maybe they don't have the equity that they predicted, I'm imagining they're going back to their original investors and saying, "Hey, well, this is a situation that's came up. Can we hold on to this a little bit longer?" And investors are saying, "Well, no. This was the original plan. We're exiting at the 5-year
Yeah.
mark." Is that generally the conversation that happens?
Yeah. It is generally the conversation that happens. And I think the investors, rightfully so, look at it as good money after bad money. The initial money became bad money when there was a seismic shift in financing and cap rates. And then it's sort of a perfect storm in a lot of those markets where, for instance, let's say if you're in Austin today, where the market is really, really received too much construction and the fundamentals have really deteriorated the last 3 years. It's just continued to deteriorate, and there's still a lot of construction going on. So not only have you had a seismic shift in cap rates and financing rates, but then you've had a deterioration in the fundamentals at the operating level. So you're giving away concessions. Your rents are lower than they were 2 years ago, and um, you've got loss to lease and delinquencies and other factors like that that just add to the underwriting, which really puts the asset well below where the initial capitalization was. So it's a really difficult position to be in, and in particular, I think with the syndicators and sort of the smaller operators versus the fund. The funds have issues, but it's not as difficult for them to accept losses and just move on. Where the sponsors in other properties that don't have a large sort of fund that as the capital partner are forced to make uh, you know tougher decisions and the ramifications from the deterioration in the investment, they can be really difficult, especially on the debt side, with guarantees and shortfalls and things like that.
David, we are coming up on time here. Thank you for coming on the podcast here
Sure.
today. Where
No,
can
thanks for
folks
having me.
absolutely where can folks go to reach out to you, whether they're in the Chicago area or maybe they have uh, questions maybe on their own journey or a deal that they may be looking at? How can folks reach out to you?
Probably through LinkedIn. I know that, uh, when I set up my information for the call today, there was a link for my LinkedIn page, and that would be a good place to reach out to me.
All right, David, thank you so much for coming on the show here today.
Yeah, thanks for having me, Don. Enjoyed it. Thanks for having me. Have a great Halloween.
Thank you.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.